So I'll get started. Hope everybody's enjoyed the presentation so far. I'll be ending on this last topic, a pretty hot one, and that's medical professionals and incorporation. So as View mentioned, I'm a Canadian senior tax manager at Moody's. Moody's is unique in that it's a law firm and an accounting firm combined. So we really try to strive to be a one roof solution for our clients for basically all their legal, accounting, and tax needs. On this slide, which I have no problem sharing with the audience, my contact information is there, so you can feel free to reach out anytime after this presentation if you have any questions or if you want to get any work done. So for my presentation here, the agenda, we'll go over the pros and cons of incorporating as a medical professional. We'll look at tax rates and the concept known as integration. Then we'll go on to just generally how you go about incorporating, a few tax tips and FYIs, then end on just generally how you would exit or the retirement strategy here, and then field any questions at the end. So pros and cons of incorporating. First pro is income deferral. That one is huge. It's likely the #1 reason why people incorporate, not just doctors, but business people in general. And we'll really highlight that on the next few slides coming. Likely the second biggest pro of incorporating is liability protection. So a corporation is its separate legal entity, completely separate from the individuals that have interest in the corporation. So there is a very good layer of liability protection for people incorporating from creditors. However, very important to note for doctors that there is no protection from malpractice, when you're incorporating. So keep that in mind. And also directors do have some liability here. So the corporate veil can be pierced in those circumstances. Things like for directors' liability would be unpaid payroll taxes, for instance. There's also potential income splitting opportunities. You have to watch out for tax on split income, which I believe came in 2016. It was a pretty big attack on doctors. So TOSI and what JP discussed regarding the PIG both came in at about the same time. And it really attacked Canadian doctors, which I find extremely unfair. Doctors are very, very needed in Canada. You're very important people, and we got to keep Canada competitive, or else you may go find somewhere else that is more competitive, such as the US. So we got to keep our professionals happy. There's also potential use of the lifetime capital gains exemption. Now, this may or may not be relevant depending on what kind of medical profession you're running. If there's no expectation of selling your shares in the future, then this point is pretty mute. But if you are have a potential to sell, then the capital gains exemption is extremely valuable. A few cons of incorporating is there's going to be some setup and ongoing compliance costs. So it's very recommended that when you're incorporating that you hire a lawyer to make sure that it's done correctly. So there's going to be some costs there. There's going to be some costs maintaining your minute book. That's not too expensive. There's quite a few low costs legal options to keep them maintaining the minute book down. And then there's also perhaps like reorg costs, things like that, that the lawyer can take care of at a future point. There's also going to be some registry costs there, and there's going to be, of course, accounting and potentially financial planner costs as well. So the accountant will be doing your bookkeeping, your year end, and your tax filings. Another big con is there's little to no benefit if you're spending everything that you earn. So again, top pro is income deferral. But basically, if you're making 200 grand a year and if you're spending it all, then there's no income deferral. You might as well stay unincorporated because you're just going to be spending more money trying to keep up with the ongoing compliance costs of the corporation if you're spending all that you're earning. It's also important to note that you can't offset losses against personal income. So probably not very relevant for medical professionals in that you're going to have positive income. You're not going to have losses. But if for whatever reason you had a loss in the year, that stays in the corporation and can only offset corporate income. Whereas if you are unincorporated and incurred a business loss personally, it can offset other personal income. You should also watch out if you're a US person. So this is a US citizen or green card holder. You'll have some extra compliance south of the border, and the income deferral might not be as large. You might have to pay some tax to the United States. So just watch out for that. It's likely still worth it, but you're really going to need a professional that's up to speed on cross-border. So tax rates and integration. So I've highlighted Alberta, and then the next slide will be Ontario. Obviously, there's a lot more provinces where you may be located. If you're interested in looking at your specific province or territory, taxtips.ca is a very good reference. They'll have this chart for every single province and territory across Canada. So my hometown or home province of Alberta, you can see here other income. Before any personal tax credits or anything like that, your first about 50 grand is getting taxed at 25% if it's other income. So other income would be things like interest income or salary. Capital gains are 50% taxable. So that's just 50% of the other income column. Then you can also receive Canadian dividends. So there's eligible and non-eligible dividends. For the most part, you'll be receiving non-eligible dividends if you're to incorporate. Eligible dividends are paid to you basically from public securities, or if you're paying high rate tax in your corporation, i.e. over the small business deduction limit that you're allowed to take. There's, as JP also pointed out, there's also a capital dividend that's completely tax-free. So it's not showing up here. You have to do an election to do that, but it's relatively straightforward. And if you have a knowledgeable accountant, they'll certainly be cognizant of that capital dividend account and make sure that you're paying it out if you ever get any balance there. So the first 50, again, taxed at these rates, and then every dollar after the 51.97 falls into the next bracket, and it goes up to 30%. You can see all the way down at the bottom, once you're above just over 320 grand in Alberta, you're getting taxed at almost 50%, 48% on salary. So it's really going to highlight in the next slides again how the income deferral in the corporation is so beneficial for medical professionals. So 48%, again, top tax rate in Alberta. Top tax rate on dividends is 34% for eligible and 42% for non-eligible. Moving on to Ontario, you can see the brackets are lower. So in Alberta, again, it's 322,000 is the top tax bracket. So every dollar after that is basically going half to the government. It's over half in Ontario, and the bracket starts at a way lower amount, being 221,000. So basically over 221,709, over 50% is going to the government. Now, just to highlight across Canada, provinces and territories, these are the top tax brackets. The highlighted amounts represent changes, not too many. And if there are, they're relatively insignificant. So provincial tax rates, basically your tax in the province you reside in as at December 31st of that year. So there could potentially be a little bit of planning opportunities, such as if you're winding up your corporation, you're going to get hit with a gigantic dividend to try to move your residency somewhere else in a lower tax jurisdiction. It's a lot more complex than just selecting your province as, say, the Northwest Territories versus Ontario. You actually have to show that you were a resident in the Northwest Territories at December 31. So that'd be things like moving up there at the end of the year and moving your spouse and children up there, moving your personal belongings, your mailing address, things like that. There's just one thing I want to highlight back on the other slides. A very, very big question. One is, So one of the biggest questions I get as accountant, should I incorporate or not? So this is, hopefully this presentation will answer that. The next question is, I don't really have a set income level personally that I need. What should I pay out of my corporation to use up my personal credits to use up, some good marginal rates here? For most provinces, it is right around the 100K mark. So you can see both in Ontario and in Alberta, once you get to about the 100K mark, it jumps about 6%. So if you don't have a set personal income level, if you're incorporated, you should probably still be paying yourself something, what salary or dividends, to use up your credits and use up your rates. And it's probably around the 100K mark is a good sweet spot. Okay, so those were personal rates. Now looking at corporate rates. So again, if you're incorporated, it's a separate legal entity. It earns its own income, it files its own tax returns, and it pays its own tax. So the small business tax rates are pretty similar across the board, across Canada. Every province, every territory, and federally, you're going to get 500K as a small business limit to start off with. And then there's things that can grind that down, such as the PIG that JP pointed out. So in Alberta, 11% will be your corporate tax rate for the first 500 grand, assuming you have access to that full limit. And somewhere like Ontario, it's slightly higher at 12.2%. Now moving on to general corporate tax rates. So this is high rate tax. If you're paying this, it's going to go into something called a GRIP, or general rate income pool. And then you'll be able to pay eligible dividends out rather than non-eligible dividends out. And that's taxed at a lower personal tax level because you've already paid more corporately. So general corporate tax rate, it's 15% federally. The combined rate for Alberta is 23%. For somewhere like Ontario, it's 26.5%. Now to hopefully bring this all together. So you're an unincorporated doctor, you're now making pretty good money. So you're making $400,000 a year. All your buddies are telling you to incorporate because the income deferral is so beneficial. Let's illustrate this now. So you have Dr. A, he's in Alberta, he's making $400,000. So he's in that top tax bracket. Again, everything after that, about $320,000, is getting taxed at 48%. So let's say he earns $100 that's getting taxed at that 48%. He's going to pay $48 of tax personally. And then he's going to have $52 in his personal genes. Okay, maybe he's content with that, but he's going, wow, that's really a big hit. That's going a lot to the government. I was hoping to retain more so I can, retire and have substantial retirement savings to live on. So if he was to incorporate, he earned that $100, it'd be 11% small business tax rate. So now he's left with $89. $89 is available to be paid out to the shareholder. So he's going to do this via a dividend. He doesn't have a GRIP balance, so it's going to be a non-eligible dividend. Dividends get grossed up because of the dividend tax credit. So it's the taxable income that's going to show up on his tax return is 102.35. Then he's going to pay personal tax on it, assuming the highest rate of tax, if he's pulling it all out, it's 42.3% on a non-eligible dividend. So combined corporate and personal taxes is 48.65. So there's actually a 65-cent cost of incorporating and pulling out all that money. So again, he earned $100, but he pulled it all out of the corporation. So there's a cost there. However, if he made $100 and left it in the corporation, there's a massive deferral of $37. So imagine how faster you can build an investment portfolio if you're incorporated, because the after tax, you don't need it in your personal hands. You invest in the corporation. Yes, there's PIG. Yes, investment income gets taxed at higher rates, but still you're going to build that investment portfolio way faster and you're going to have a nice retirement nest egg. So note on these corporate tax rates, this was the active business income, and this was general corporate tax rates. This is assuming active business income, i.e. the income you earn as an active medical professional doing medical services. Passive income is taxed at much higher rates. As JP pointed out, it's about 50%. And this is your initial tax hit in the corporation. However, if you pay yourself a dividend, generally some of that will be refundable to the corporation through a mechanism called refundable dividend tax on hand. So what integration is trying to do is basically, if Vu is an unincorporated professional and I'm an incorporated professional, we both earn the same amount, and I pull everything out of all of the money out of my corporation, he's getting a salary. At the end of the day, we should be paying about the same amount of tax. So there is a bit of leakage, as you can see here, with 65 cents tax cost if you're incorporated, if you're pulling out all your money. So again, if you're pulling out all your money, if you're spending all your money, there's usually not much benefit of incorporating. However, if Vu was unincorporated in my example and I was incorporated and we both actually didn't need that extra money, he's paying that tax right up front. He can go invest it personally. That personal investment income is going to be taxed at a little bit of a lower rate than if it was corporately. But me, I don't need it personally. I'm going to go invest it, and I'm going to have a lot more money initially to go and invest. And at the end of the day, when I go retire, I'm going to have a way bigger portfolio. So again, passive income taxed at higher corporate tax rates, but it's still, that deferral is still very much worth it. The deferred earnings, again, saved in the corporation, can be invested into a whole bunch of different investments. Insurance can be purchased, pensions can be purchased. You can go into a non-registered investment portfolio. And this is where an integrated advisory team is very, very important. So if you're looking to incorporate, or if you already are, it's very important to basically have health checks. Make sure your advisory team is all on the same page. The lawyer's on the same page, your financial advisors like Nick or Simon are on the same page, and your accountant is on the same page. So the investment advisor isn't implementing a pension where it doesn't make sense for tax purposes for whatever reason, or they should have done insurance, but now they're investing all this cash into non-registered investment portfolio. Everybody's got to be on the same team. So make sure all your professional team is working together and communicating with each other. Okay, so with that, I really hope this highlighted why incorporation is so beneficial, why that income deferral is so beneficial. So now you may be wondering, if you're not incorporated, how you can incorporate. So generally speaking, this is how you would incorporate. You have to be self-employed. So if you're a doctor and if you're working as an employee earning salary, you're not going to be able to incorporate. You're going to have to be a contractor, or you'll be running your own clinic, something like that. So make sure, one, you're self-employed. Two, again, it's important to note that a corporation is its own legal entity. You need to incorporate the professional corporation in the appropriate jurisdiction. You need to make sure you get all the appropriate certification and approvals by the College of Physicians in your appropriate jurisdiction. Then you would subscribe for shares of the corporation and other potential shareholders. Make sure you're on side with your college. In many jurisdictions, other shareholders are allowed to buy in, such as family members, but it generally has to be non-voting shares, where the medical professional would be holding voting shares. You would then become a director, officer, and perhaps an employee of the corporation. If you already were unincorporated and running a practice, maybe you have some equipment or other assets to transfer to the corporation. This can be usually done on a tax deferred basis. So you'll need a good accountant to make sure that they're taking care of that. And if you have staff, i.e. even if it's just receptionists, you have maybe some family members on payroll that are doing some services for you, I encourage you to use a payroll provider. I know how busy doctors are. Payroll, while it seems pretty easy, if you mess up on it, it's not your money, right? It's the employee's money, and you're making remittances on their behalf. So it's very important to get these numbers right and make sure the remittances are going in on time. So I really highly recommend to use a payroll provider instead of trying to figure it out yourself. Okay, so going on to a few tax tips and FYIs. So whether you're incorporated or not, just bringing up the TFSA shortly, tax-free savings account. So this is a very, very powerful tool. And before you start getting into the non-registered portfolios, even really before you start investing in RRSPs, generally, and now Nick and Simon can correct me if I'm wrong, but I always like to max out the TFSA first. The 2023 annual limit has finally seen a little bit of an increase from the normal 6,000 to 6,500. The cumulative contribution limit for a TSFA up to 2023 is $88,000 if you were born by 1991. Pay very close attention to limits. So basically, if you exceed the contribution limits, you're going to be penalized with a 1% penalty per month for the time that the overcontribution sits in that account. You really want to pick safe investments in a TFSA that are going to give you a solid return. Don't go too risky. So there was a court case recently where an individual invested a whole bunch of money into his TFSA, actually over-contributed. So now he's getting hit with the penalty. He went in, once that money was in his TFSA, invested it in pretty risky investments. All those risky investments cratered. So now the value has shot down significantly, but he still has to pay this giant penalty because he did over-contribute. So the benefit of the TFSA is everything is tax-free. But again, try to pick solid, safe investments, because any tax losses, i.e. if it goes down, if you sell for a loss, you're not going to be able to do anything with that loss because the income in there is tax-free. So you're not going to be able to offset any gains or anything like that with the losses you may incur. Again, RRSP, whether you're incorporated or unincorporated, if you have earned income, you're going to get contribution room to your RRSP. RRSP can be very powerful. The 2023 annual contribution limit is just under 31,000, and you'll need about a salary of about 171K to max that out. Also, again, pay close attention to limits. There's a very annoying form called T1 OBP if you go over. I hate filling this form out. So don't go over. There's again a 1% penalty per month when you're over contributed in an RRSP. And just to give an overview in RRSP, basically how it works is if you have contribution limit, you can contribute up to that amount. You're going to get a tax deduction in the year you contribute if you want to take it, or you can carry it forward to another year if your tax rates are going to be if you're going to be in a higher tax bracket in the future year. Basically, you're going to get a tax deduction. So the idea is to get a tax deduction in your high income years. Then later, when you're retired, you don't have too much other sources of income, you're in lower marginal rates, you pull that money out, you're going to get taxed on it. So hopefully you're in a low marginal rate. Then while through retirement, you're going to try to dwindle this account down. When you pass away, the value of your RRSP is included in your income on your terminal tax return. So if you have a gigantic amount in your RRSP when you pass away, assuming you don't have a surviving spouse that it can transfer to and be deferred until they pass away, you're going to get hit likely with a very large tax bill. Okay, so just going over potential expenses for both employees and self-employed. So everybody on this call is likely making a pretty good significant income. You want to lower that income for tax purposes as much as you can while still being on side with the Income Tax Act. So if you're an employee, you might need to have a signed 22T2200 on file. You don't need to send this to CRA, but it's just an agreement between you and your employer, and you'll have to give it to CRA only when they request it. This form will go over exactly what you're basically paying personally in order to perform your employment duties. So maybe you're paying for a cell phone that you're using for work all the time. Maybe you're using a car, maybe a home office, all these sort of things. As long as it's in that agreement, you should be able to deduct the expenses against your employment income. Now, whether you're incorporated or not, there's a whole bunch of expenses that you should be keeping track of in order to knock your taxable income down to a lower amount. That could be home office expenses, professional fees, professional dues, travel, meals and entertainment, phone, and other expenses. Okay, so basically to generally be deductible, they have to be for the purpose of gaining or producing income. So if you have maybe a one-off expense that isn't listed here, it could still be deductible. So you should be checking with your accountant to make sure you're getting the most bang for your buck and make sure you're lowering that taxable income as much as you can. The CRA, they love to review home office. They love to review travel, professional fees, and meals and entertainment because it's easy pickings for them. They do a review. If you don't have support for it, they're going to kick it out. And they love doing it. It's easy for them. It's an easy win for them. So for home office expenses, it's going to have to be a reasonable space in your house, and you have to only claim the expenses that are used for the time that you're using it for employment or corporation duties. So don't be claiming like the whole main floor of your house or anything like that. Just claim maybe 1/6 of your house or 10-15% of your house, whatever your actual office space is. Make sure you're keeping receipts for everything, especially so meals and entertainment. Entertainment for doctors is going to be pretty minimal, but there likely will be a few business meals that you may incur during the year. Make sure you keep your receipt. And I always suggest that you write on the back of your receipt what the meal was incurred for and who you had it with. For travel, this could be things like going to conferences. It could also be vehicle. CRA loves going after vehicles because, again, it's easy pickings for them. You should be keeping a mileage log. It's a huge pain, especially for busy medical professionals. If you get reviewed, you could try to build a log at that point. But again, just an FYI, keep it in mind that you're at least trying to keep somewhat of a log between business and personal use on that vehicle. Make sure you're tracking your mileage just as support if CRA ever goes and reviews you. So on that note, just highlighting automobile limits and rates. So if you're incorporated or if you're a sole prop, you could purchase a vehicle for the business. If it's a class 10.1, so basically if it's a passenger vehicle now exceeding 36K plus sales tax, that's going to be the amount you can take capital cost allowance on or tax depreciation on. If you're leasing the vehicle, there are leasing costs, max leasing costs that you can deduct. So if you're leasing a Ferrari, so you're not going to get that full lease payment deducted. But normal passenger vehicles are probably right around that limit. So you're probably going to get that full amount or very close to it. If you're using a personal vehicle for business purposes, say you're incorporated and you have a personal vehicle, but you're driving around for the business all the time. You want to get some benefit. You want to get a shareholder credit for that. So generally there is a reasonable allowance that CRA abides by, and that's about 61 cents per kilometer for the first 5,000 kilometers and 55 cents after that. Again, keep mileage log for this and be very cognizant of any personal use on that vehicle. So you might throw a vehicle in the business. You think it's used 100% for business purposes, but generally from home to your place of business and back is considered personal. So if you're a doctor that goes around to several hospitals, if you're traveling from one hospital to the next, or if you're going from your clinic to pick up medical supplies, things like that, those vehicle expenses will likely be deductible. Now, if you're a medical professional that needs to buy equipment, such as that vehicle, or if you buy computers, if you buy fancy expensive medical equipment, you should keep in mind that the Department of Finance has rolled out immediate CCA expensing. This came out, I believe, in budget 2021, and it took forever to receive royal assent, but it finally did in June of 2022. So now this is law, and basically individuals, so if you're not incorporated, you can claim 100% CCA for things acquired after January 1st, 2022. This is for corporations. It began January 1st, 2021. Property must become available for use before 2025. And note, it includes almost all new depreciable property. However, some property is carved out, including classes 1 to 6, and then a few obscure classes. Classes 1 to 6 are essentially buildings. Note, though, leasehold improvements are not carved out. So if you lease a clinic and you do this nice renovation in there, you're going to be able to get this immediate CCA expensing. Vehicles are also not carved out, and also things like computers and other equipment are not carved out. There is a max limit of 1.5 million, and it has to be shared between the associated group. This includes partnerships, corporations, and individuals for the purposes of these rules. Okay, so now you are incorporated, or you're looking to incorporate, and you're thinking, how am I going to compensate myself? Well, the biggest thing is you have to figure out your personal cash flow needs versus what you want to leave in the corporation for that income tax deferral that we've been speaking so highly about. So figure out that. Then you're going to want to look at what balances you have available in your corporation. So if you have a shareholder credit balance, this is when the corporation owes you money. You can return that money to you tax-free. You could also do a paid up capital reduction. So basically, if you've injected money into the corporation, like if you bought shares from Treasury for $1,000, under a legal resolution, you can return that money to you tax-free. You could also, as JP pointed out, do a capital dividend account payout. An election is required for this. However, again, it's a quite simple standard election. All your professional accountants should know how to do this. If you don't, you should probably maybe go look at finding another accountant. But basically, that is another very, very powerful tool. When you're looking at compensation, you got to be very aware of where your shareholder balance lands. If it's in a debit balance, i.e., if you owe the corporation money, then this should be cleared. If it's not cleared by a certain time period, then it's going to become a full income inclusion to you personally. So generally how most medical professionals operate is they get incorporated and then they pull money out throughout the year. So they're pulling 10 grand each month for personal living expenses. So now they pulled out $120,000 throughout the year. They have a December 31st year end. Now they go over to their accountant, say, okay, prepare my year end, prepare my tax return. The accountant is going to look and say, oh, you owe the corporation $120,000. Generally, you're going to have to clear that amount through a taxable way. Unless, again, you have one of these bullet points above. You're going to have to clear that debit balance by a taxable amount, generally salary or dividend. If you don't clear that debit balance by the end of the next taxation year, it's going to be a full income inclusion. So it's in general practice, we clear it every fiscal year. So clearing it every year just keeps it nice, and it doesn't run into a problem of, okay, now I pulled 120 grand. I don't want to pay any personal tax. I'm going to leave it as a debit balance. Now you go to the end of the next taxation year and you pull out another 120,000. So now you're going to, now you're going to get a $240,000 dividend, whereas you could have spread it out evenly throughout the prior 2 years. So it's good to keep it always cleared. And again, if you pull it out as a dividend, you're going to get the dividend tax credit rather than being a full income inclusion, which would be hit at that salary or basically interest rate, that other income column. So pretty punitive. If you do get that income inclusion, you can pay it back in a subsequent year and then takes a deduction for that. But it's usually just want to avoid that whole mess altogether. Technically, if you do owe the corporation money under subsection 80.4 sub 2, you should be charging yourself an interest inclusion based on the prescribed rate. In practice, nobody ever does this, but it's something to be cognizant about if you're not following that interest inclusion, especially now that interest rates have gone up. CRA may be looking at this a little bit closer now, but again, everybody does it. So they may want to lay off because it's not going to just upset doctors, it's going to upset business people as a whole. Okay, again, if a set amount of personal cash is not needed, you can consider targeting a taxable income threshold. So again, on those previous slides, I said about around 100 grand is a good income tax or income threshold to reach, because after that it's going to jump a pretty big amount, about 6% in Alberta. You could target your RRSP limit, or you could target CPP limit. Always when you're paying salary or dividends, you need to watch out for the reasonableness of that salary. And you also want to watch out for TOSI implications, or tax on split income. So so basically, if you're paying yourself, it's not going to matter. You're the one active in the business. You can pay yourself whatever you want. CRA cannot deem that active medical professional to have an unreasonable salary. So you can pay yourself whatever you want. However, if you have a family member, say your wife is doing some bookkeeping, or your husband's doing some bookkeeping, or some other admin tasks, you can pay them a reasonable salary. Or you could pay them a dividend if they are a shareholder. But again, you have to watch out for TOSI. TOSI is out of the scope of this presentation, but basically, if you pay a dividend or an amount to somebody and you don't find an exception out of tax on split income, the full thing is taxed at the top marginal rate. So it's very punitive. So if there's a bit of a gray area here, if you're unsure that the amount isn't accepted from TOSI, I would generally prefer you pay a salary, because if the salary is deemed unreasonable, the corporation just won't get a deduction for it, but the person receiving that salary will still get access to their marginal rates. Whereas if you paid a dividend that's subject to TOSI, it's with after-tax dollars, it's coming under retained earnings, so there's no deduction to the corporation anyway. But that full amount received is getting taxed at that top marginal rate by the recipient. Sorry. Okay, and then the last thing, so Vu actually touched on this briefly, surplus strips. So these could be implemented to extract property out of the corporation at lower than dividend rates. So 99% of the time when you extract property out of the corporation, is going to be done so via a taxable salary or a taxable dividend. Taxable salary, again, in Alberta, top tax rate's 48%. In a lot of other provinces and in a lot of other provinces, it's over 50% in the top tax rate. Dividends are a bit lower. Say you're paying a non-eligible dividend at a top tax rate, that's 42.3% in Alberta, even higher in places like Ontario. So you're going, wow, that's a huge, huge hit to me personally. Let me try to keep it lower. So you hire someone like Moody's to do a surplus strip for you. By way of a series of transactions, basically you trigger a capital gain and you pay tax at the capital gain, or very similar to capital gain rates, which is about 25%. So 25% versus 48%, you're winning. There is certainly complexity with doing these surplus strips. You're going to want to hire a professional who knows what they're doing. They're relatively high fees to implement. There is potential audit risk. CRA obviously doesn't like them. However, if they're done right, they haven't been shut down yet. And this is always kind of a thing, usually before the budgets come out, is a potential capital gains rate increase. So right now, Again, a capital gain is only 50% taxable. If the capital gains rate increases, then the surplus strip isn't going to be as attractive. The other bullet point on here is potentially offside. So you could be potentially offside with your college. I know many doctors doing these, they're very popular. So to be honest, the colleges don't really care. But again, you might want to get approval from the college, or you want to really make sure that you're doing your due diligence here. Because generally how the surplus strip is basically you'll be incorporating a holding company who will be holding shares in your PC at a point in time. And that will generally not be okay for that point in time, but it's usually cleared up by the end of the day. So the colleges, in my opinion, usually don't care, because at the start of the day, it's only you holding voting shares, and at the end of the day, it's only holding you only holding voting shares. Just have a few questions here. When a corporation gets RDTOH money, so dividend tax on hand, can that money be paid out as a tax-free dividend if you also have CDA credits? No, so a refundable dividend tax is refundable dividend tax on hand, also known as RDTOH. There's two buckets for it. So the Liberals have introduced that PIG, they've introduced TOSI, and they've introduced two buckets of refundable dividend tax on hand. So they've made it way more complex for everybody, not just medical professionals. But basically there's two buckets. One is non-eligible dividend tax on hand. One is eligible refundable dividend tax on hand. A taxable dividend has to be paid in order to access the refundable dividend tax on hand. So if you're paying a CDA, you're not going to be able to access this refundable dividend mechanism. Then one other question, given the way tax integration works, and there doesn't seem to be any advantage to receiving 100% in dividends, and in light of this 7 tax deductions coming from using a pension plan, does it still make sense to advocate 100% dividends approach? No. So I like dividends, honestly, because it makes my life easier for the most part. Salary, I gotta make sure that the client's doing their remittance on time. There's just more work around the salary. A dividend is basically a lot easier. I declare it at year end. I get the lawyer to do the dividend resolution, and then I book it in their accounting, and I record it on the tax return. It's a little bit easier than salary, so it makes my life easier. But if your accountant is just simply paying dividends and you don't know why, you should ask them, should I be taking some salary here or some other method of compensation rather than just me paying out taxable dividends each year? We actually have on the next slide salary versus dividends, so that hopefully will clear it up a little bit. But no, just advocating 100% dividend a compensation approach isn't the right approach, and I don't like that. I think accounting and tax has to be very, very tailored to the individual on their needs. So just watch for that. Okay, so slide I was talking about, salary versus dividends. So this is another question I get asked all the time. You got to consider the following. It's always a question of fact, like most questions in tax. Client comes to me and say, should I pay salary or dividends? And I'm going to say it depends. And then we're going to look at their individual scenario. And I'm going to say, okay, well, if you're paying yourself a dividend, you need to watch out for tax on split income. Again, if you're the active medical professional, TOSI isn't going to matter. But if you're trying to pay to your 20 or family members, you're going to have to watch out for TOSI and try to find an exception. You're going to want to review potential balances in your corporation. So this would include GRIP, general rate income pool. So again, this is if you receive public security eligible dividends, or if you paid high rate tax, you should have a GRIP balance. If you have a GRIP balance, you can pay out an eligible dividend, and that's taxed at a lower rate than on uneligible dividends, and certainly taxed at a lower personal rate than salary. You also want to look out for NERTO and ERTO. So this is the non-eligible refundable dividend tax on hand and eligible refundable dividend tax on hand. So dividends, do have a lower personal tax rate due to tax paid at the corporate level. So they're really just trying to maintain integration, i.e. VU's incorporated, I'm incorporated. At the end of the day, if we pulled out all our money into our personal genes, we should be paying the same amount of tax. Again, it's not perfect, but it's pretty close. So since you pay tax at the corporate level, when you pay out a dividend, you're going to get taxed at a bit lower rate than you would if you had paid yourself a salary. When you're paying yourself a salary, you're making income, you're paying income tax basically with withholdings throughout the year. So when you do your personal tax return, you throw in your T4 that you already have a whole bunch of income tax withheld. So you could probably even out and not, like, assuming salary is your only income source, maybe you don't have a tax bill. For dividends, you got to watch out for potential installment requirements you have to make quarterly, as tax is not withheld at source on dividends. So a lot of times a client comes to me, they've been paying themselves salary for years. We switch them to dividends because it makes sense for a whole bunch of other reasons. We always got to be cognizant to tell them that, hey, you should be making installments throughout the year. And if you don't, be aware that you're probably going to end up with a big tax bill at the end of April. Okay. And if preferred shares are issued, so this is generally during something like an estate freeze, where you take back preferred shares, they have a locked-in redemption value. So you're going to be wanting to redeem these throughout. There's usually a deemed dividend equal to redemption value less PUC is the deemed dividend, which is going to be taxable to you. You can declare a capital dividend to make it tax-free on this redemption. But basically, when you pass away, the fair market value of your assets are generally going to be taxed unless you have a surviving spouse where it can be all rolled to and deferred. But if you have preferred shares with a redemption value of $1 million and you pass away, that's going to come into your income and be a capital gain. So you want to chip away at those preferred shares to lower your terminal tax liability. Now, on the flip side, if you want to pay yourself a salary, if you're in BC, i.e. British Columbia, also known as bring cash because their tax rates are so high, BC, Manitoba, Ontario, Newfoundland, watch out for employer health tax. Watch out for the reasonableness of salary. Again, if you're the active medical doctor, reasonableness is not an issue. But if you're paying family members, it should be reasonable based on the work they performed, i.e. what would you pay a third party to do that work? Corporate losses, so likely not relevant for medical professionals, but if your corporation has losses, paying a salary, you're going to take a deduction for it, which will only further increase your corporate loss. So if you don't have future income, that corporate loss is just going to be trapped in the corporation. You're not going to be able to make use of it. Salary, when you pay salary, it's known as earned income. Dividends are not. So you may want earned income, i.e. at least maybe some of your compensation to come from salary if you have childcare expenses. Or if you want RSP contribution room. And there are a few other things like disability support deductions may require earned income, i.e. salary. There could be a cash flow advantage of paying a salary versus a dividend because at the end of the year, maybe you want to clear that debit balance via a salary, a bonus, because a payment of a bonus, you can defer the actual payment of that bonus to the individual up to 180 days, and it will still be deductible in that fiscal year you cleared that bonus. Really watch out for payroll remittance requirements. Again, if you have several employees, then I recommend using a payroll provider. If it's just simply like you're paying yourself a bonus, you and your accountant can certainly figure out that payroll remittance and make it by the deadline. You're going to have a higher personal tax rate, but it's going to be a deduction to the corporation. There could be a little bit of an impact on the adjusted aggregate investment income. So you could try to get a little fancy here. And that PIG, what JP talked about, is again, once you hit that 50K of passive income, your small business deduction starts to be grinded. Once you hit on 150K, your small business deduction is completely gone. So perhaps maybe you can pay yourself a salary and say this salary is for my services, not of medical services, but basically my work done on my investments. If you can do that, then you could perhaps take that salary and lower your adjusted aggregate investment income to try to get you under the threshold. Again, you would have to really argue that that salary is not for your medical services, but for the work you're doing on your investments. If you're simply having someone like Nick and Simon doing your investments and you're completely passive, you're completely out of the picture, it's going to be a little bit hard to argue, but still something like meeting with them quarterly, signing things, making sure the investments are performing how you expect them to, you could probably argue a little bit of salary at least. Family members and the actual active medical doctor, you're generally going to be EI exempt. So you're not going to have access to employment insurance, but also you're not paying into it. So that's kind of a win. Just watch out if you're expecting to take maternity leave or sabbatical or something that you would generally take EI on normally, you're not going to be eligible for. There is a voluntary EI program for people in this boat, but I do not suggest it. It's expensive. If you pay into it and if you take maternity leave, say once, you have to continue paying into it for the rest of your working life. So it sucks. I don't recommend it. So someone asked, can I take dividends as a sole prop? No. So you'll basically be filling out Schedule 2125 on your personal tax return. And this is basically just an income statement showing your income, all your expenses, and then the amount you're getting taxed on. So that's already in your personal genes. There's no need to pay a dividend. A dividend can only be received by someone who's a shareholder of a corporation. And again, just because you're a shareholder of a corporation, if you're receiving that dividend, you have to watch out for TOSI, because again, if TOSI applies, it's going to be taxed at the full top tax rate. So things, how do you get accepted from TOSI? It's a little bit out of the scope of this presentation, but for instance, if you're active and CRA deems this generally as 20 hours plus in the business a week, you're accepted from TOSI and you can pay yourself a dividend. Excluded share definition is that has also an exception. We won't get into it too much, but the biggest thing is you have to be holding the shares directly, and it can't be service income. So likely your family members aren't going to meet that exception. It's mostly the excluded business exception or a reasonable amount if you don't meet that 20-hour plus test. So it's usually just easier to pay them a salary because you know it's going to be safer. And if it's deemed unreasonable, the implications aren't as bad as if you paid them a dividend subject to TOSI. Okay, just a few last slides here. So income splitting. So now you've incorporated, you want to bring your wife in as a shareholder. Maybe you have adult children going to school. Maybe you want to bring them as a shareholder, bring the whole family in as shareholders. This was awesome before 2016 because TOSI didn't exist. And if you had adult children going to university, you wanted to fund their university, perhaps your wife or husband are stay at home, they're not making any income, you want to use up their marginal tax rates. Prior to TOSI coming in, if they were a shareholder, you could pay them whatever you wanted as a dividend. TOSI shut down income splitting opportunities significantly because now, again, if you pay them a dividend, you got to watch out for TOSI or it's going to be taxed at the top marginal rate. So what income splitting opportunities besides dividends do you have? Well, you could simply gift cash to adult children. Say they're trying to buy their own house or again, they're going to university. You can simply gift cash, not property, but cash. If you're gifting the house, there's going to be tax implications, but cash there isn't to adult children. You could pay them a reasonable salary or a dividend that isn't subject to TOSI, or you could enter into a loan agreement with a spouse, family member, or family trust for the purpose of gaining or producing income. So how this works is basically, I'm husband, I'm making tons of money. My wife is stay at home. She's at a low marginal tax rate. I lend her a whole bunch of cash and she takes that cash and goes and invests it. Generally, between spouses, if you did that, the income earned on her investments would attribute back to me. So we didn't really accomplish anything. However, if she gives me fair market value consideration for that cash that I gave her to go invest in an investment portfolio, then attribution no longer applies. So then now that investment income is going to be taxed in her hands and she can use up her marginal tax brackets. So you could loan her and actually have a loan agreement. The loan agreement basically, as at by Jan 30th of the following year, an interest payment is made to me. I include it in my income. She gets a tax deduction for the interest paid to me. And then she's including that investment income in her hands. This was a very, very good planning opportunity for a very long time. In fact, this time last year, the prescribed rate that interest you have to charge to your spouse was only at 1%. So awesome. Currently, it shot up to 5%. So it's only going to make sense to do a spousal loan or a loan to a family member or family trust if their investment return is going to be larger than 5%. So it's made it a lot harder in these current times. Once you lock in this loan, it's good, the prescribed rate stays the same for the whole duration of that loan. So if it goes up later, it's still going to be locked in at the time you locked it in. So if just watch prescribed rates, if it goes down and if you're looking to do this, it will make sense. At 5%, it probably does not make sense right now. All right, so exit plan retirement strategy. So if you're an employee or if you're an unincorporated medical professional, just running through your schedule 21-25, like I mentioned, you're going to have a reliance on personal assets for retirement. So this could be things like your RSP account, your TFSA, CPP, insurance, all those great things. However, if you're incorporated, you're going to have a whole nother set of potential assets used for retirement. So if you're incorporated, you're going to get that huge income deferral. Then you can go invest in a whole bunch of different investments. You're going to build up the investment portfolio a lot faster generally than somebody incorporated might. So what are you going to do with this corporation when you retire? Well, you can transition it from a PC into simply an investment holding company for retirement. So you would keep that corporation around. You would keep the investments in there. Once you are 65 plus, TOSI does not apply where you're paying dividends to your spouse. It doesn't matter the age of your spouse, it's you that matters. So once you're 65, you're out of TOSI. So you can pay them whatever you want, use up both your marginal tax rates. Great. The shares of this company can transfer to your surviving spouse tax deferred until they pass away. So again, when you pass away, if you hold shares in a company, they're going to be deemed to dispose of at fair market value. So it could be a very big tax hit. Make sure you're planning for this. If you have a surviving spouse, they're going to be deferred until they pass away. Okay, so you can transition it, or you can simply wind it up upon retirement. However, there may be significant tax implications to this if the corporation has assets. So generally assets, if you're trying to pull them out of the corporation to you personally, have to be done at fair market value. So if there's a whole bunch of inherent gains in the corporation, you're trying to pull them out, they're either going to be big capital gains in the corporation, and it's going to also likely cause dividends to get the cash from the property out to your hands too. Third one is you could sell the assets or shares of your corporation. This might be unlikely for medical professionals, but for certain medical professionals, you may actually be looking to sell your assets or your shares. So if you sell the assets, the corporation is the one selling the assets. You're going to sell the assets out of the corporation. The corporation will pay any capital gains tax, things like that. And then it's going to be left with a whole bunch of cash. And then if you want that cash out, you're going to have to pay dividends out to clear it up. And then you can dissolve the corporation, or you can sell the assets out, keep the corporation, and go invest that corporately. So that's selling assets. That's an asset sale versus share sale. So generally, if I'm a buyer, I want to buy assets. If I'm a seller, I want someone to buy my shares. Again, so buyer, they could pick and choose the assets, and they're also not taking any liability that may exist in the corporation if they're simply taking assets out, because they're not buying the corporation, they're just buying the assets. That's generally why buyers prefer asset sale. Sellers prefer share sale because they're going to be done with the corporation. They're no longer exist. They're out. They're running free. And also, very, very big benefit is the capital gains exemption. So if your corporation qualifies for the capital gains exemption and you sell your shares, you're going to get a very big shelter on that capital gain of up to about 900K now. So it's very beneficial if you're looking to sell your corporation in the future, that your shares will qualify for the capital gains exemption. Okay, and with that, we'll end with any last questions. I think I've answered all the ones in the chat so far.
Yeah. Thank you very much, Matthew. We have lots of questions that are not on the chat.
Okay.
So I'll go through them one by one, but I think they're fairly easy to answer. What percentage of medical professionals incorporate? Do you have those numbers at Moody's? Do you have an idea? And does this indicate that tax professionals recommend incorporation versus remaining a sole proprietorship?
So I don't know the percentage of medical professionals that are incorporated. That's actually a really good question. I wish I did know. However, what I see is after like 2-3 years of practicing, what I see is the vast majority are incorporating. So perhaps they start their first few years as unincorporated, but they're always moving to incorporation. And again, that's generally because the huge income deferral. So generally, we can take a look at your individual circumstance, but generally I would very highly recommend incorporating. And that's, again, basically if you're not spending as much as you're making. So if you have money left over, incorporate, because you're gonna have that huge income deferral. You're gonna be able to build up your investments much quicker.
Okay. And you talked earlier about incorporating versus sole proprietorship, and if you take all your money out, like you leave no money in the corporation and no retained earnings, there was a 67 cents in your example, 67 cents drawback, meaning you're actually overpaying to incorporate and shouldn't do it if you remove all retained earnings. That is based on the assumption of a financial calculation. So mathematically, you're right, you're down 67 cents. But from a planning perspective, I see it very differently, because if you're someone who has a family, or you're now starting a family, you're thinking of things like RSPs, you're thinking of things like pensions, you're thinking of things like insurances. And so insurances bought inside the corporation at 87 cents on the dollar is better than 47 cents on the dollar. So in my mind, I think I agree with you that there are really not much reason not to incorporate. There are obviously exceptions in the world. There's always an exception to the rule. But I agree with you that in the vast majority, if not above 90 something percent, there are still good arguments to incorporate, even if you left no money in the corporation.
Certainly, yeah. Certainly, I agree. Actually, so JP just left a comment in the chat, and maybe a little bit outdated information, but the last time he heard 93% of physicians are incorporated now.
Yeah, he said 6 years old. So there's still I'm still dumbfounded by the amount of physician colleagues who are not incorporated. And a lot of the reasons they are not is because of the argument that you made from a mathematical perspective, that if you take all the money out, because you're right. Physicians make $100, but they spend 120. So, so they spend more than they make. So there's obviously no money left in the corporation. And so the common wisdom is if you're doing that, then you're spending 67 cents that you shouldn't be. So that's why they're not incorporated. But given what we've talked about the entire day, the incorporation is both a financial argument, but also a strategic and planning argument, which leads to my second question here. Can I take dividends as a sole proprietor?
No, so you wouldn't be able to. So that sole prop, like the cash is already in your genes. You're not paying yourself a salary or a dividend. It's yours. You could pay someone else a salary. You're only getting dividends if you're a shareholder of the corporation.
Correct. And the next question is, can I set up a pension as a sole proprietor?
I believe you can. I'm not a huge pension guy. Maybe JP can comment on that, but I think you can.
So you can for someone else that's working for you. So if I'm Joe the plumber, sole proprietor, and my daughter Celeste is on salary, I can set up a personal pension plan for her because she's receiving employment income from the sole proprietorship. So therefore, I can sponsor it, and she will be the beneficiary of that pension plan. She'll be saving money there. But I, the sole proprietor myself, cannot, because, like you said, I'm not getting any salary. It's all my money. I'm not employed by myself. So I'm not an employee. Therefore, I can't have a pension by myself, but my employees can.
Okay, good. You said something that really, really interests me. So, to do the RESP, to do the disability tax credit, etc., you mentioned that you needed an earned income. So you cannot take a dividend. You need an earned income to be eligible to claim those credits back. As someone who works in long-term care, I have to fill out a lot of these, tax credit forms for all the caregiver that they've been, caregiving for their elderly mom or elderly dad. And so I've been filling a lot of those forms, and I'm just thinking for myself, when I'm taking care of my parents right now, because I'm a sandwich generation and I'm taking care of my kids, I'm also taking care of my parents. If I take dividends only, does it mean I can't apply for those credits for my parents? So I have to have an earned income. Is that correct?
No, so for the caregiver credit, or if you're paying medical expenses on behalf of a dependent, that's different. You can still take that credit.
Okay, got it. So for which credits are we talking about that you needed an earned income?
So there's something known as disability supports deduction. So this is where the individual has an impairment, physical or mental. If they meet certain criteria, then they can take a disability supports deduction from their earned income. So it's a little bit one-off. You don't see it too often. Or like if you Google disability supports deduction, the first hit will be like from the Canada website, and you can learn more if you think you might fall in that boat or if you want to learn more. But it is kind of one-off. But that's for an individual that has an impairment. It's a deduction specifically for them. So again, it's not going to affect your potential caregiver credit benefit or medical expenses you paid for your parents as they're dependent on you, things like that.
Okay, got it. And so when you say for the disability support credit, that's for the individual. So if a physician is either burnt out or taking leave because of mental illness, depression, anxiety, whatever, does that qualify?
Again, you have to like go over the eligibility criteria on the disability supports deduction. It's like it has to be an actual impairment. If you're burnt out, it's probably not going to qualify. But if you have an actual like learning disability, then you may qualify.
Oh, got it. Okay,
Things
got
like
it.
that. An actual, and the disability supports deduction is again very clearly different than the disability tax credit, which
Okay,
has gotten broader recently. So more people will qualify for it. I don't know if you fill out those forms, you, but they're very beneficial to people. The disability tax credit can be transferred to other individuals. So if like basically if husband's not using it, perhaps the wife could use it. And say if the person was supposed to qualify 6 years ago and they just now get approval, the doctors filled out the form, they just got approved, CRA will automatically retroactively go back to those 6 years and apply it throughout those years for
oh,
them.
okay.
So it's a very, very beneficial credit. So if you know anybody that could potentially qualify for that, make sure that they're jumping on it.
Okay, very good. There's one, we're almost out of time. We still got about 10 minutes. So I want to make sure that everybody has a chance to ask their question. What are some of the biggest pitfalls or misinformation you're seeing when first meeting a new physician from either a new or a senior professional about taxes, about incorporation? What are some of the most common pitfalls or outdated information?
So I think two of the biggest things are they're not incorporated, which throughout this presentation, I think we've come to the conclusion that you probably should be incorporated. So that's one of the biggest things. And the next biggest thing is they're spending too much. So where doctors do generally make a very good income, a lot of them do spend quite a bit. So hopefully you have advisors like myself, Nick, Simon, to kind of guide you on like what your budget should be, how much you should be packing away for a rainy day kind of thing. So I think those are the two biggest pitfalls. And then maybe just not savvy enough in advisors. So if you have a team like Nick, JP, they're going to make sure that you're actually taking advantage of the pensions, insurance. Like IPPs are a very beneficial tool, but I almost never see them. So just making sure that your advisors are aware of these things and bringing them to your attention. Salary versus dividends, maybe the accountant just always threw the dividend on because it's easier for them. But maybe this person should have been taking a bit of salary. Maybe they've been paying a whole bunch of childcare expenses and they never got a deduction for it because they don't have earned income, or for whatever reason, maybe they should be contributing to their RSP and they don't have earned income. So it's the salary versus dividends thing too. But the biggest things, again, come full circle, is incorporating. Is they're still not incorporated, and they should be.
Now, you mentioned something that's very curious, because you mentioned IPPs, that you don't see a lot of IPPs or even PPPs, individual pension plan or personal pension plan. We talked about that earlier in the day. And you say you don't see that because planners and financial planners don't talk about it, or because you don't talk about it, or how can we increase people's awareness of it?
I just think for the general accountant doing your year end, they just overlook it. They're just not well versed in it. They don't have somebody on their team that's well versed in it. So they just don't bring it to your attention. And then the doctor's so busy, they're dealing with a whole bunch of other things that they never think of it either. So it just goes missed.
And as a tax accountant, because you're a different breed of accountant, you're not like the other people who just filed their taxes. So as a tax accountant, is this something that is more into your discussion with your clients?
I mean, we definitely do bring it up, make sure it's a full circle, fulsome picture. And if it makes sense for the medical professional or whoever else the client is, then we'll certainly bring it up and see if it works.
I've got 8 more minutes, but I'm gonna ask one last question because we're really in the times for it. You mentioned a lot about, deducting the cars and the meals and all that. I know that there's a particular, clause for electrical vehicles when it comes to, deducting EVs. And I talked about that in one of my podcasts, and someone was just raving about it. So do you want to just maybe tell us what that tax tax credit is for the EVs. Some of the people on the call may have or may want to buy one, and that may be beneficial for them.
Yeah, so I think the biggest thing is you were going to get 100% CCA deduction, but they've also now implemented that immediate CCA expensing, so that doesn't really matter. But at the time of purchase, you may be able to qualify for a tax credit beyond that immediate CCA expensing. So at the time of purchase, if you're buying a new EV, I believe it's under certain thresholds. So if you're buying like a top line Tesla, it's probably not going to qualify. But if you're buying like a Nissan Leaf or a base level Tesla, if it's under, I can't remember the income threshold amount, but if you're under that, you can potentially get a tax credit at the time of purchase.
Okay. So something to look at and to investigate with your accountant. But there are some benefits to tax wise to purchasing an EV.
Yeah, I guess on the flip side to that, if you're looking to buy a luxury car, now there is a federal luxury tax on top of sales tax. So if you're buying a new boat, a new airplane, or a fancy new car, I believe the car is over 100 grand. So that is actually, it can't, it's a nice car, but it's not insane. You still might be able to, you still might on the time of purchase be hit with this new tax.
Right. Okay, well, Matthew, that was amazing. That was a lot of information. Lots of information, but good information. But I think what I take out of this is there's a lot of things we need to know about tax accounting. Obviously, tomorrow I'm not going to become you, and I'm not going to become a tax accountant. So we definitely need experts like you on our team that Nick mentioned. So thank you very much for giving us all those teaching points and letting us know about all the different tax strategies when it comes to incorporation.
Certainly, my pleasure.